putting yourself in the shoes of the investor. My name is Tom Clendon, and I am an ACCA SBR expert tutor. And I want to talk to you about investor focus, about trying to put yourself in the shoes of the investor, because this is something that comes up in the exam. And it comes up in the exam in question 4. It's a very relevant skill to be able to communicate to the investors as to what is going on in the financial statements. And this is something which is regularly examined. And the idea of this short video is to try and give you an insight and support on this area. Because when I read the examiner's reports, I'm aware this is a question which is not normally done very well. Now, maybe that's down to time management. Maybe that's down to knowledge. Let's see if we can address some of that knowledge issue. So, when we talk about putting ourselves in the shoes of the investor, we have to think who they are. And the conceptual framework identifies that the providers of equity finance are the primary users of the financial statements. They are our audience. They are the primary users. They have given their capital. They have given their money. They have invested in the business. And the directors have managed the company on their behalf. So there is a stewardship responsibility that the directors and the company have to the shareholders to tell the investors what has gone on. So the primary users are the equity shareholders. But when we talk about investors, we're also talking about people who lend money to the company. Yeah, people who have subscribed to bonds, subscribed to debentures, who are long-term liabilities so far as the company is concerned. So you've got these two types of investors, equity and debt. Let's think about equity first of all. Let's think about what their information needs are. What do they want to know? Well, crudely speaking, cutting to the chase, profit. They've put their money in the business and they want to know whether the business is making a profit. But investors are smart, they think long term, and therefore they're also interested in the sustainability of the business. So these days, sustainability is embedded within the SBR syllabus. We can't talk about investor needs without thinking about their needs for the long-term survival, the long-term interest of the company. Equity shareholders are interested in the value of the business, the value of their shares. And one way of valuing their shares is to look at the dividend valuation model. Not that you would have to apply that model, but dividends are an important thing that investors want to know about. Are they going to get a dividend? Yeah, how much are they going to get? And dividends are paid in cash and out of profit. So equity shareholders want this information because they're going to be making decisions. And what decisions are they going to be making? Well, they own shares. So maybe they could be buying more shares. Maybe they could be subscribing to a rights issue. Maybe they're not current shareholders but are thinking of becoming shareholders. Maybe they've got decisions to make about buying, selling, or do they hold? They also have decisions to make around the management of the company. They appoint the board of directors. So they are voting at general meetings. They decide who the directors are. They vote on things like their remuneration, for example. So equity shareholders have decisions to be made. Debt. If you have lent money to the company for the long term, if you've bought their bonds, you are investing into that company. Now, people who lend money to the company are not as obsessed with profit as the equity shareholders are. Put yourself in the shoes of somebody who has lent money to the company, and you want to know whether you're going to get it back, whether your interest is going to be paid. That's what you're interested in, and therefore it's about the cash flow of the company. It's about the debt covenants of the company. You may have imposed debt covenants. You may have said that, you've got to maintain a certain interest cover, you've got to maintain a certain gearing, and that becomes a really important information need to know whether the company is in breach of those covenants, because if they are, that's an early warning signal, and perhaps under the agreement, you then have the right to foreclose, you then have the right to call in the loan. Now, some lenders have a charge. Some lenders have security. And therefore, you're interested, if you've lent money and have a charge over certain assets, you're not interested in the cost of those assets. You're interested in the fair value of those assets. What are those assets worth should you have to repossess them? We are putting ourselves in the shoes of an investor who has lent money. We're thinking about their information needs, and we're thinking about the decisions that they are going to have to make. They don't get to appoint the board of directors. They have a decision to, do I call in the loan? Yeah. Do I think this is too risky? Yeah. Or do I lend more? Yeah. Is there another round of funding that the company is asking me for? And therefore, in those circumstances, there's an information need about the future, about the credibility of management. So think about the sort of things that investors who own bonds, what are they going to do? They could sell them. Yeah, they could factor them. They could get rid of them in some way, shape or form if they're not comfortable that in the future they're going to get those returns. We are putting ourselves in the shoes of the investor. And I'm throwing a pebble in a pond. And I am trying to get you to think and to be critical, to evaluate whether or not the current regulatory profit and loss account, statement of financial position, cash flow, notes of the accounts, do these financial statements actually meet the information needs of the investors? And I'm trying to be not controversial, but I'm just trying to make you think. We give them last year's profit. We give them last year's cash flow. We tell them an historic story. And I would argue that a lot of investors actually are more interested in what is going to happen rather than what has happened. They're interested in the future. And to that extent, the past information isn't wholly satisfying their information needs, because you can't always necessarily extrapolate past patterns into the future. The operating cycle of many businesses is over a generation. Wind farms. If the business you're thinking of has the business model of building wind farms, the payback period, for building a nuclear power station or wind farms is a generation. And what we're doing as accountants is we're saying, in the last 12 months, we made this amount of profit. Well, that's just not going to cut it when you're trying to evaluate the success of a very long-term project. So financial accounting is orientated naturally to a 12-month cycle, but that is not always echoing the reality of long-term capital projects. And the statement of financial position. So many users make the naive assumption that the balance sheet represents all of the assets and represents the value of those assets. Now, you know and I know that we use a mixed measurement system. So some of those assets are at cost. They're not all at value. You and I know that inherent goodwill is just not part of a balance sheet. And you and I know that brands, inherent brands that you've created, they're not shown on the balance sheet. All that software, a lot of stuff, that customer list that we've created is not shown. So the balance sheet in no way, shape or form represents the value of the business. So maybe, just maybe, there's a reporting gap. There's a shortfall between what investors want and what we provide them. But perhaps I'm being a bit harsh, because there are some remedies to that shortfall. Disclosures, for example. You know, within the syllabus, you've got segmental reporting. Within the syllabus, you've got related parties. These are disclosures that are made in the notes to the accounts, which enhance the users, the investors' understanding of the performance of the business. So disclosures, I think, can play a part in helping investors understand, as can integrated reporting with its emphasis on, you know, the capitals other than financial capital. And of course, sustainability reports, massively important, as regulated now by S1 and S2, very mainstream these days. Okay. Alternative performance measures. And I'm just going to spend a minute or two talking to you about alternative performance measures, because when you put yourself in the shoes of the investor, a lot of companies present APMs. Yeah, present APMs. So if you're in the airline industry, yeah, you might be giving in your financial statements statistics around seat occupancy. Yeah, the percentage of seats, and clearly that are occupied on an average flight, on the flight. And that's going to be more efficient the higher the number it is. You might publish information around how many of your flights were cancelled or delayed by more than an hour. Because a well-run airline won't be delaying flights. A well-run airline will have a full cohort of passengers on its aeroplanes. So publishing this information is not required by an accounting standard. By definition, alternative performance measures are not required by IFRS. I mean, the most famous EBITDA, earnings before interest, tax, depreciation and amortization. So company A might produce an EBITDA and think, oh, okay, what we'll do is we'll exclude some really weird one-off items. We were sued this year, so we'll exclude that loss. And we reorganise this year, so we'll exclude those costs. And therefore, this is our EBITDA, because we're looking at it before some weird stuff. Company B may take a different attitude to that weird stuff. You can't compare A's EBITDA with B's EBITDA, because EBITDA is a made-up number. When I say made up, I mean it's not regulated. It's not a term that is found in an IFRS. And therefore, I think it needs to be treated with real caution, because I don't think it's reliable. I don't think it's comparable. Different companies will do it in a different way. Now, you might think here I'm being hypercritical of alternative performance measures. Yes, I think we've got to be skeptical. I think we've got to treat them with a pinch of salt. I think they are fantastic when they really give you an insight into the specific business, into the management of that business. They are entity specific, and to that extent, they're really useful because they're very relevant to the information needs of the investor, because it's specifically about the company, like the airline occupancy rate. But are they a faithful representation? Are they reliable? This is always going to be an element of discussion. So investors, their information needs, I don't think, are wholly met. And in attempting to meet them by producing alternative performance measures, again, you have to just exercise a little bit of professional judgment, in my opinion. So let's think about some questions that you could be asked around investor focus, around putting yourselves in the shoes of the investor. Explain to an investor why the tax charge in the profit and loss account is a different number to the tax paid in the cash flow. Can you think about that? Now, there's more than one reason. I think the simplest reason is simply to say that tax is paid in arrears. That the tax that you pay this year is in respect of last year's tax assessment. And the tax that you charge this year is matching with this year's profit. So tax is paid in arrears. You're paying this year last year's tax. And therefore, this year's tax expense won't be the same as the tax you paid last year. So that's a simple explanation. There's another relatively simple explanation I'm just going to throw at you. I say 12. Deferred tax. Because deferred tax is part of the taxation charge. If you've got a taxable temporary difference, you're creating a deferred tax liability, there will be a charge in the P&L. But you're not paying any more tax. It doesn't affect the cash flow. Deferred tax is credit deferred taxation liability, debit expense. So you've changed the taxation charge, but you haven't changed the cash flow. So that's one of the reasons why, or two of the reasons why, the taxation charge is a different number. And somewhere in the notes to the accounts, there will be a reconciliation of the two. Good. In an exam situation, by the way, you wouldn't just write paid in arrears or deferred tax. You would need to flesh out that theory, that explanation. Let's have a look at another question. Finance costs. Explain to an investor why the finance cost that has been charged in the P&L is a different number to the interest paid. Okay. Finance costs. Strictly speaking, finance costs not only include the interest that you pay, but they can also include discounts on issue, premium on redemption. They can also include issue costs. There is a bigger cost to borrowing money than simply the interest that you pay if you pay a balloon at the end, a premium on redemption, if you pay issue costs, if you allow a discount on the issue. And that's a very valid reason why finance costs and interest paid will be different numbers. Okay? You know this in the cash flow. You add back the finance cost in the indirect operating activities, cash flow. You add back the finance cost at the top. And then one of the figures at the bottom of the operating activities is interest paid. And it's a different number. It's a different number. The finance cost is based on the effective rate. You're never going to have to calculate the effective rate. Not in SBR anyway. So the finance cost is based on the effective rate, whereas the cash that you're paying is a different number. It's the coupon rate on the nominal value. There's another reason too. Not all finance costs are expensed. Maybe you've borrowed the money to build an asset. Maybe you are buying raw materials, paying labor to construct a building that you're going to use as property, plant and equipment. And maybe you're borrowing money to finance that construction. So during the period of construction, the finance cost, the interest on the borrowings, would be capitalized. So you would be paying interest, you'd see that in the cash flow, interest paid, but none of it would be expensed through the P&L because you capitalize the interest on monies that you borrow in order to finance the construction of an asset during the period of construction. All right? So finance costs can be capitalized. There's more than one explanation for why the finance cost in the P&L is not the same as the interest paid. Keep swimming. Keep moving. Keep going forward. I've not told you everything that I know about investor focus. You've got to find additional resources and think further about this issue. But luckily, that's quite easy because the ACCA provide you with the study hub. Go to chapter 20, analysis and interpretation. Look at the additional resources there and the articles. There's a series of articles on this area. I particularly like the one on business model. So yeah, do some reading, do some thinking, look at the material, look at the past questions. Listen, thank you so much for engaging and listening to me in this lecture. My name is Tom Clendon, and I help students pass SBR onwards and upwards.